Greetings, folks, from Seton Hall University. I'm here now in my office. We record this from all different places. And today what we're going to talk about is revenue recognition and operating income on the income statement. So with revenue recognition, the concern is that companies are recording revenue at the proper time. And there's a lot of opportunity to fool around here and to try different things. And we want to be very careful that companies are recording their revenue properly so that we are valuing them the best way, evaluating the best way that we can. Now, what's interesting here is that we're right on the cusp of a huge change, and this is the new FASB rules for revenue recognition. And these rules go into effect for 2018, which is the year that we're in right now. And the core principles of revenue recognition are pretty much the same, but the new revenue recognition rules create a new level of consistency across all different types of revenue that companies could earn. And the basic rule is, whether you're under the old system or the new system, is that you recognize revenue when the goods or services that you're selling are provided to the customer, and that you don't need to receive the cash in order to recognize the revenue. In other words, the customer could pay you in advance. The customer could pay you long after they receive the service, but basically you're going to record the revenue whenever you provide the good or the service that you're supposed to provide to your customers. Under the new rules, this is called the performance obligation. In essence, under the new rules, every sale involves a contract, which could be in writing or it could be implied, between the customer and the company, whereby the company agrees to transfer a good or a service to the customer, and the customer agrees to pay for it. And so what needs to happen in order to recognize revenue is that good is transferred to the customer. In other words, you deliver your goods to the customers, or you provide the service that you've been contracted to provide. And delivering the goods or providing the service is what's considered to be the performance obligation. The way we would say it is that the performance obligation has been satisfied, and therefore you can recognize your revenue. So one situation is with a sale on credit. This would mean that you provide the service now or the goods now, the performance obligation is provided now, and the customer agrees to pay you at some point in the future. You're always going to recognize the revenue. I shouldn't say always, almost always going to recognize the revenue when you transfer the goods to the customer, you provide the service. In other words, the performance obligation is satisfied. And at the same time, you're going to record an accounts receivable, that's an asset, which you're going to collect at some later date. And recognizing revenue is not affected by a delayed receipt of cash. All that has to happen is the company fulfills its performance obligation. So for example, if you mow lawns, and what you do is you mow lawns all month long, and then at the end of the month you give your customers a bill, and the customer pays you the next month, you can record the revenue from mowing lawns when you actually mow the lawn, rather than when you collect the payment from the customer. So what you need to do is you need to satisfy the performance obligation. And a number of different things could happen that would determine that you've satisfied the performance obligation. In other words, done whatever it is that you're supposed to do in order to recognize revenue. One thing is you transfer legal title to the goods over to your customer. Another one is you transfer physical possessions of the goods to your customer. Another is that the customers assume the risk or rewards of owning the goods, or the customers accepted the good or service and therefore has the obligation to pay the company. So if any one of these things happens, then you could argue that the performance obligation has been satisfied, and therefore you can recognize revenue. Now, where the new standard gets changes existing practice, and it doesn't really change it, it just makes it more consistent, is when you provide multiple products or services for a single price. And most larger sales involve the sale of more than one product. And the new standard explains how this should be accounted for. What you're going to need to do is you're going to need to break the sale down into the distinctive goods or services that can be valued each on a standalone basis. And then you're going to recognize the revenue on these distinct components. I'll give you an example. Let's say that you go to Verizon and you buy a cell phone. You're actually also agreeing to use the cell phone for 2 years, let's say, or for 18 months, 20 months, something like that. And you're agreeing to pay certain rates to Verizon for use of the cell phone. So you're really buying two things from Verizon, not one. You're buying the physical cell phone, agreeing to pay them over time for it, and you're also buying a contract to use Verizon's services over a certain period of time. So that's two different things that you're buying. Now, you might also be buying a service contract in case it breaks, then they're going to agree to return it. That may be a third deliverable set or component separate from the other two. And what the seller is going to need to do is they're going to need to break the contract down into its individual components so that, and then treat each one as a separate products. Now, how would you determine that individual components are distinct? If the customer can use the good or service on its own, or the good or service is not highly interrelated with other goods or services sold per the contract. So a physical cell phone has a separate value from a contract for cell phone services. Similarly, one could argue that an insurance policy on a cell phone, that's what a service contract is also a separate service from the physical cell phone or the right to use data and voice and all of that other stuff. So therefore, in that contract, you would have three deliverables: the physical cell phone, the contract to use Verizon services for 20 months, and then the third one would be the service contract in case the cell phone breaks. And you're going to need to break it into three distinct pieces and determine a separate sales price for each one. So this gets really complicated, and some of the complications are non-refundable upfront fees. So sometimes you require customers to pay a fee upfront. For example, if you bought a cell phone recently, this probably is an upfront fee. And oftentimes this needs to be recognized when the goods or services are provided rather than immediately when the money is collected. A bill and hold arrangement. So this would be a situation where you bill the customer, but the customer is entitled to pay you over time. And again, that's cash flow, so we're not so concerned about that. We're concerned about when you provide the performance, when you've satisfied your performance obligation. Another one is consignment sales. That would be when you give someone a product and say, here, you sell it for me, and you can keep 10% of the money. In that case, and so you're entitled to 10% of the money on the sale once you can sell it. You can't recognize that commission until you sell it to the outside party. Licenses. So this would be a license to use some kind of intellectual property. And this can be recognized when the customer can first use the intellectual property, or if it's a promise of access to a license, it can be recognized over a period of time. With franchises, goods and services oftentimes needs to be recognized when they're delivered, but sometimes also they're recognized over a period of time. It doesn't say that there. And finally, variable consideration makes things really complicated. That would be when the price changes depending on certain outcomes. How that's done, it's a long story. Anyway, here's an example. And in this particular example, this is called a cost-to-cost method. So let's say this company incurs 15% of the expected cost to create the product in the current period. In that particular case, if you've incurred 15% of the cost, then you can record 15% of the revenue. Let me give you an example. Let's say you have a construction project that's going to take many, many years. And you're you've spent 15% of the money needed on this construction project this year. That would entitle you, you've satisfied 15% of your performance obligation, and therefore you can recognize 15% of your revenue. Here you can see another example. This is a $7,500 contract, and in year one they've spent $4,500. So they've spent 60% of the money. The revenue, their sales price is $10 million, so they can recognize $6 million in revenue. They've done 60% of the work. They can recognize $6 million of the revenue. And the cost recognized would be the cost that they spent so far, $4,500, and therefore they would record $1,500 in gross profit. Now in year two, let's say they spent $3 million and the contract is done. So they've done the other 40% of the contract. They can recognize 40% of the revenue, that's $4 million. And in year two, they have $4 million in revenue, $3 million in expenses would result in $1 million in gross profit. Now, even if a customer pays in advance, that doesn't mean that the performance obligation has been satisfied any sooner or later. So a customer paying in advance doesn't necessarily impact the recognition of revenue. Rather, receiving payment in advance would create a liability. The actual journal entry would be debit cash, credit, unearned revenue, a liability, because you've received money which you have not yet earned. And then as you record the revenue, you can take the revenue out of that liability. So this would be the opposite of the previous example where we set up an accounts receivable. In this case, we're creating a liability because the customer paid us in advance. The accounts receivable would be a situation where the customer is going to pay us afterwards. So if the customer pays, if there are costs in excess of billings, that's going to create an asset. So if you've spent money which you can't yet bill your customer for, it's still an asset. It's like in a receivable. The actual count would be contracts in process.